everybody. Welcome to our Ask the Experts session. Today, we are going to be talking about the top 10 home inspection do's and don'ts for buyers, and LeAnne's going to cover debt to income ratio. And so with that, allow me to introduce myself. I am Laura.Gilsdorf with Madison and Company, primarily based out of Evergreen, Colorado, but I tend to serve the whole Front Range depending on where my clients want me to go. And LeAnne, go ahead and introduce yourself.
I'm LeAnne, a loan officer with Universal Lending, and I service all of Colorado, Arizona, and Texas soon. Very soon. Yeah.
Cool. Awesome. I can't wait for that announcement.
I know. It feels like it's taking forever, but Texas has some harder guidelines for us to get licensed there.
Holy cow. Well, good luck with that. And then we'll just go ahead and dive in. So home inspections are probably, from a real estate perspective, one of, if not the most important part of buying a house. So not on the finance side, LeAnne could dive into that, but on the selecting of the home, there's obviously everything that goes into dreaming up what kind of house you want, where you want it to be, everything else. But then you get to the point of finding it. And pretty much your first task as a buyer is going to be your home inspection. So I'm going to run through some do's and don'ts. What you really want to focus on first and foremost is don't skip it. Do not skip the home inspection, no matter how crazy the market is. And if we look back to a year ago, home inspections were getting skipped a lot. And thankfully, not too many of my clients had any major, things happen because they skipped home inspections. But it definitely can happen where you end up having to replace a whole roof or a sewer line or, things that are really, really costly. So no matter what the market is doing or how good of a condition the home seems to be in, I really advise you do not skip the home inspection, but instead you hire a qualified and experienced home inspector to ensure that you know what you're getting into, because things might look great, but that doesn't always tell the whole picture. That brings us to the next section, which is don't rely solely on the seller's property disclosure for information on the property's condition. I can't tell you how many times buyers are buying from sellers who have never lived in the home. It's been an investment property. They're just not the do-it-yourself type, so they don't keep good records. You name it. There are so many reasons why the seller's property disclosure is not going to be your primary source of information about the condition of the home.
And even if it's very thorough. And the disclosure, can you explain what that is?
Yeah. So the seller's property disclosure is a pretty thorough document that the sellers are required to fill out that is supposed to be in real time. So it's not the condition of the home 3 months ago when they listed the house. It's right here, right now, what is happening with the home, what do I know? And it's a very thorough outline that they're supposed to go through and indicate where there's been any issues. And with that, there's a lot of rules and regulations for us as real estate professionals that we have to guide the sellers to disclose. And rule of thumb is basically, if you know about it and it happened during the time that you owned the home, you need to disclose it. So I'll get a question a lot, which is, well, we had a water leak, right when we moved in, but we fixed it. Do we have to disclose that? Because they say, well, we fixed it. Why do we have to disclose? Because I don't want to dampen the appeal of the property, right? But the answer is always yes. And now, because I know about it, we definitely have to disclose, because I have a legal responsibility to disclose all known artifacts about the property, whether they were repaired or not. So on the seller side, it's really important to remember too, especially if it's something that you fixed, disclose. So does that answer your question, LeAnne? Yeah. All right, cool. So don't just rely on that. But when you're going through the inspection, I would recommend that you attend the inspection and ask as many questions as you can and review. Give the inspector some space to do their thing for the first hour or two, however much is needed, but take a look at the property yourself. This is going to be the one time that you really get to spend time in the property, because you probably only spent 15, 20, maybe 30 minutes max at your showing when you first made an offer. So this is the opportunity for you to really get a feel for the home, get to know the home, get to know the ins and outs, and make sure that it is going to work for you. Then you want to review the inspection report carefully, ask any clarification, consider potential repair and maintenance costs, because that's going to go into negotiating whether or not the seller will make those repairs. Typically, the larger the ticket price on the repair, or the more severe the repair, the more negotiating room you have, especially when you're weighing it against the value of the home and what you offered. That can get into a much bigger conversation that I'm happy to have with anybody on a case-by-case basis, but when you're looking at the negotiation of what to ask the seller to fix versus not, it's kind of an obscure equation, if you will, on what is the house listed for? What did I offer? Did I offer at list, over list, under list? And then you kind of play into the psychology around what the seller may or may not be willing to do, and then enter the negotiations. And you also want to consider if there's any permits that might be necessary on the work that's required. So for instance, if you have to get a roof replaced, probably going to need a permit. If you're doing some minor electrical work, probably not, but that's all going to play into the timeline of, you know, your closing period. A couple other don'ts is, don't overlook potential health and safety hazards such as mold, lead, and radon. Radon's a huge one in Colorado, especially if there's a basement. So I always recommend that you do a radon inspection. Don't assume that cosmetic issues are the only problems with the home. So if you are going into a home that doesn't look pristine, just do a little bit more due diligence to see what exactly is going on. And then most importantly, don't rush through the inspection process and don't overlook the important details. It's, as a buyer, this is a big purchase and a big investment. And so you want to make sure that you know what you're getting into. Doesn't matter how big of a project you're getting into, because everybody's willing to get into a different type of project than others. But I'd rather have every single buyer know what they're getting into and choose that than have any big surprises later on. And that's all I have.
And that makes sense. No, just at the beginning, you said people were, waiving their inspection. And why was that?
It was a competition play, basically, because this time last year, or a little sooner, I guess we had kind of died down by this time last year. But if we look at how hot the market was back in 2022, buyers were having to really go to extreme lengths to have their offers selected by sellers, because sellers were getting way over asking price, quick close, cash, you name it. And so it was one other layer of advantage where they were saying, hey, I won't do any inspection, which tells the seller, great, they're just going to buy the house as is. I get to walk with all this money no matter what. So it was just another negotiating tactic to be able to buy the home.
So, I mean, really, it makes it a better opportunity now to buy.
Yes,
and sell.
Absolutely. Absolutely. Things are much more balanced for both buyers and sellers. So it's just a more fair market today than it was a year ago.
I like to hear that. All right.
So we're going to talk about debt to income.
Yes. And I think if anyone's ever looked up debt to income or talked to anyone in the mortgage industry, they referred to it as DTI. So your DTI, your debt to income, is something that lenders look at to really see how much they're comfortable with lending. And so we look at your total monthly debt and we divide that by your gross monthly income. So it is gross. So a lot of people ask that. And it's all the debt that shows up on your credit report. So it's car payments, student loans, any personal loans, credit cards. Sometimes you see a phone if you've taken a loan out for your phone. I'll see that, but not often. They're not going to include things like your cable bill, your phone bill, any little things like that, unless you self-report those. So it is important to us as a lender to make sure that we are comfortable lending dependent on that debt to income. And 35% is considered great. We love 35% debt to income, but we can go higher depending on the different loan programs. So if you're a first-time home buyer and homes are expensive, we might be able to go up to 50% debt to income. For doing government loans like FHA, VA, we might be able to go above 50%. So it's good to talk to a mortgage lender to decide, what kind of program what kind of program will you be able to use with your debt to income? I always tell people it's just good in general when you're thinking about purchasing to just look at your debt to income, because we're looking at your gross debt to income. We're not taking in all those other cable bill, your phone bill. We're not taking any of that into consideration, and we're using your gross. So it's also good to budget. You don't want to get into a home where 50% of your total income is just going to the bills in your credit report, your mortgage payment, and then you don't have any excess funds at the end of the month. And so it's important to me, and I think we've spoken about this before, that we also do like to do a budget with some of our buyers to make sure that what we're putting them into actually makes sense and they're not each month house poor.
Yeah, absolutely. And I get the question a lot on my side of like, well, why 30%? So do you know, is there a rhyme or a reason to that magic 30%, or is that just?
So, I mean, it is, the magic is because you have extra. If your water heater breaks or your car breaks down, whatever that extra payment may be that month, you can afford it without having to put it on a credit card or without having, take out maybe a personal loan or to finance something. So that 35% is really where someone has those extra funds. But with the prices of homes, the interest rates rising, I honestly probably don't see a lot of 35%. Most people are going to be between 40 and 45%. So I don't want to scare people away if they're at 40, 45, but it's good to just budget and see really what you can afford, what monthly payment you are comfortable with.
Yeah, that makes sense. Well, budgeting is key, I would say, not just for buying a home, but for lots of areas of life. So if you don't do it yet.
I mean, it's good for anything. I always tell people, car payments, student loan payments, anytime you're thinking about financing something, it's good to look at that picture and say, okay, how much is this going to increase my debt to income?
Right. Absolutely. Well, I didn't have any questions other than the ones I kind of ran through already for today. Did you have any on your end?
I did. I mean, I had one, and someone was just asking about VA. VA is, essentially they don't have a debt to income. They do, but they don't. But they're a little bit more lenient on their debt to income. We look at other factors besides just your monthly debt and your gross income. So if you do have a VA loan, it's good to talk with any mortgage lender, and we can look at residual income. We can look at a whole bunch of different things to see how much you actually qualify for.
All right, well, that's good to know. And so if I hear you correctly too, just to reiterate, there's no exact like border barrier boundary on debt to income. It just, you have to look at it in order to know what is going to be the best program for that particular buyer, right?
Yeah. I mean, and I like to tell people, I mean, 50% is really the max.
Yeah,
Can go higher with some loan programs. For conventional, good credit, 50% is really your max that they're going to allow. With the government programs, they'll go more. But at the same time, if you're spending over 50%, then we want to make sure you're comfortable with that.
yeah, absolutely. Okay, cool. Well, thank you so much for being here with us this week. If
Thank
you
you.
all want to stay on top of what's happening in the real estate and lending markets, be sure to subscribe to the channel and click the link below to get the little reminders. And as always, if you need anything at all, feel free to call, text, or email either one of us anytime.